Hold on just a second. It takes a second for me to get this live stream going.
So Andrew, you put all the way to what page?
Haven't gotten there yet. Okay. Angie Banks.
Here.
Christina Bennett. Joe Clark. Darnetta Clinkscale.
Here.
Lewis Cross. Sheila Goodwin.
Here.
Donna Jones. Yvette Levy. Bobby Richardson.
Here.
Albert Sanders.
Here.
And Justin Stein. You have 5. It's a quorum. So you can turn it over to Kristen.
All right, Kristen, we're going to turn it over to Kristen Cook to get her report.
Yes. Andrew, are you putting it on a screen or?
Yeah, let me.
No worries. I am not rushing at all.
Okay. So what page would you like me to go to?
Maybe you can just start on page 2.
That one?
Sure. So yeah, let's talk a little bit about what happened in the first quarter. The first quarter was very difficult. The good news is as we start to see subsequent performance, markets have come back, but COVID really moved us from being in what we kept talking about as a late cycle environment to more of a recessionary environment. And so as you remember, the markets kept going up, 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 and up. And we said it seemed like they were going to continue to do so unless we had some sort of shock to the system. Well, we got the shock to the system. It was COVID-19. It has had a global impact, both from mainly from a health perspective, but that has rolled over because of the closings, because of the economic shutdowns throughout the globe, has had a devastating impact on the markets, the economy, on joblessness numbers as it relates to the number. We're close to 14%. We've actually reduced a little bit, which is positive as it relates to people being unemployed, but that continues to be an issue. We are starting to see states roll back their shelter in place standards and posture. However, we also are starting to see peaks. And so while we have seen great performance in April and May and a little bit of June, this is performance report is as of March 31st. And so that is where we were hit very hard. Just to remind you, and it seems so long ago, but we really started seeing shutdowns around March 9th, 10th, 11th. I think Massachusetts was set to shut down March 12th. And so that little bit of time, that 2 weeks, the markets just collapsed almost. And so that's what we're seeing. So when you, that's what this first page is talking about. But as I'm talking about our quarterly performance, I do want to highlight that there is some light at the end of the tunnel. So it's not all doom and gloom, but of course, for this period, we did have some negative returns. Maybe you can keep going, Andrew.
Okay.
You can keep going. So if you turn to page, oh, I'm sorry, you can stop at page 5.
Okay.
So just to give you some perspective, I've already given you the background, but when you look at where we see a lot of red arrows going down when we look at the macro, equity, credit, and real assets. What's interesting though is the US dollar is higher. And so that's good for our buying power. However, of course, we're still in the middle of a trade war with China that from a policy standpoint, we're not sure exactly how that's going to shake out. And we are still having limitations, I would say, on global trade given the shutdowns across the world. They are starting to open up in other countries. That VIX number, I think it's really important. VIX is a proxy for volatility. So that is letting us know that the volatility is extraordinarily high. It's up high, it's going up, even though it's red, which means the higher it is, the worse off it is as it relates to the portfolios in the market. So markets have been going crazy. However, there are and have been, whenever you have a market that just gets dislocated, it does provide opportunities for some types of managers. So we will be starting to look at, as we move through the year, opportunistic credit, private debt. You've already started that historically, but this is a time that the vintage years will likely be very positive. And so after the 2008 recession and any other recessions that we've had, investing in private markets at that time have been able to provide stellar returns. And so that's something to look forward to. But as you scroll down, you see the equities, both from a domestic and US standpoint, have been down. Credit has been down. High yield and emerging market debt, they do follow a little bit closer to the equity markets. However, the US Barclays Agg, which is your core fixed income, that has done well. Spreads have been widened. They are starting to come in now. Oil was down 67% in March. It has subsequently come back, so that's good news, in particular as we start to drive and use gas and things of that nature. The supply has been reduced globally, which is good because the demand is not as high, but we are starting to see an uptick in demand. So those are all positives. Maybe you can keep going. Actually,
Is that a good page, Kristen?
Actually, you can keep going. I want to go to the total performance because I've given kind of the backdrop of all of this at this point.
You want our performance?
Yes.
Okay. Hold on just a sec.
No worries. So,
That one?
there we go. Oh,
Okay.
Yep. There we go. So when we look at our performance, you can see that for the 3-month time period, it was down 15.1%, which was in the 82nd percentile rank. We'll talk a little bit about why that is. When you scroll out to the 1 year at negative 7.8%, which is devastating. But I have to tell you, when I look at your portfolio relative to some of our other clients' portfolios, there were, I think our average was around 10 to 12%. So you actually, despite it being negative from an absolute standpoint, relatively, you have been able to stay the course a bit. When you go out to your 3 and 5 years, you still are posting positive returns. When you look at the bottom part of your chart here, you can see your actual target, or your actual exposure versus your target. And so the dark green is where you are currently with your asset allocation, and the lighter green is what your target is. And so as you can see, you're overweight areas like large cap equity, underweight small cap equity, but in particular non-US equity. And that's partly because it hasn't performed as well as US equity. And so we're seeing that core bonds is a little bit higher. It has performed well. That said, you're not grossly out of whack as relates to your targets, so you're still within range. So that's something that we have to keep an eye on as we think about whether we need to rebalance or not. So we can move on, Andrew. So from a risk return standpoint, we'll look at the 3-year here, and we see that this green is your portfolio is a little bit more, the return is not as high as we would like to see. And there are some reasons for that, which we'll talk about again as well. So you have quite a bit of, you have a few managers that are value managers within your portfolio. Your value managers have not been performing well. This has been a growth-oriented market. It has been for some time. We would have expected potentially that with the shock in the system that would have reversed, but it did not. And so when I'm thinking about your portfolio and the type of managers that you have, that's been something that has hurt you for sure. And so, it is what it is. It's I think it's going to move as you start to see some of that positive performance come through. But that's what we see it as at this present time.
So could you explain this graph to me a little bit?
Sure.
Tell me what the scatter is. I mean,
Sure. The scatter are just other portfolios. The green box is
Okay.
you.
Okay,
The return is going to be on the, I think that's the X. X goes up, right?
Yeah. Mhm.
The x-axis. So your return is on the x-axis. So you see it's not over that line. We would have liked to see that over that the actual 0 point, right?
gotcha.
And or the middle point. And then your standard deviation is your risk. And so there have been times where we really want to be in that top left quadrant.
Gotcha.
Where we really want to be. So this box being not in the top left corner quadrant says that we need to start to look back a little bit at the attribution and see where we may have had a little bit of style drift and make some
Okay.
potentially make some adjustments.
Okay,
Okay.
okay, thank you.
Mm-hmm.
Do you want me to keep going?
Yes,
Tell me when to stop.
sure. So this is an okay.
That one?
Yeah, this is just an interesting chart for you to know. This just gives you perspective on what your growth is looking like or not and what your cash flows are. So on the bottom where you see that light green, those are your benefit payments. Those are any of your liabilities that are coming out of the portfolio. On top where you have the dark green, that's going to be the actual principal, the total portfolio. So we are down right now as of March. As I mentioned, when we look at some of the subsequent performance, you likely will have gained a decent amount back. Actually, as I was mentioning, I was looking at your preliminary flash when I started having some issues a few minutes ago. And so for the month, you were actually up and you were in some positive territory when we looked out 1 year. So that compared to that -7% that you're seeing as of March 31st has to be taken into consideration. So with that, you would have also seen an uptick. You should have seen an uptick on your total value of your portfolio as well.
That page, you're going to keep going to detail a
You can
little
keep
maybe?
going.
This one? You want to go here?
Sure. Yeah. So when I'm looking at this portion of your portfolio, you may say, okay, what's driving those red numbers? And as we're looking at this, because yellow is actually not in bad, and you have a lot of yellow, green is best, orange is not great, but then you have this red. And so when we look at what is causing the red in your portfolio, it's really going to be your international managers. So in particular, Causeway has had significant negative performance for you at -0.8%. As an example for
There they are. At the bottom of that page, you can see it.
yeah, you know what, and I was looking on my phone, I didn't know how far you had.
Yeah, yeah.
I was able to pull it up. So negative, so you see across the board, that is, you know, Causeway is something that we're going to need to touch base a bit more on. But you know, Causeway has actually over time, you know, you can see when you look at your inception number, you know, it has provided value. It has been a high flyer for you in the past. But Causeway is a value manager. And so value has really not done well, as I have mentioned. And so growth managers have done much better. And we can see that, you know, throughout your portfolio. I mean, you have Westfield, if you scroll up, you see, I mean, you know, Systematic, all of those managers have done well. Systematic is a quantitative manager as well. And so we've
Where are
seen
they?
their performance as, that's
Help
okay.
me. Is it okay?
It's fine. You know, managers like Edgar Lomax, which have been real high flyers for you also, have
There they are.
done well for you over time. You know, they've trailed a little bit because they are value managers, but again, they're not broken in any way, shape, or form. And so we have to keep that in mind as we think about this portfolio.
So let me ask this question. So what do we do about the red? I mean, do we keep them? Do we do something different?
So with the red, I would recommend that we put them on watch. But I also don't ever want us to make a knee-jerk reaction. And I wanted to highlight Causeway because historically speaking, Causeway has been one of your best managers.
Gotcha.
all managers are going to sort of have their ebbs and flows. And so we want to look and peel back the onion and see, okay, is this manager, is their process broken? Or are we just in a situation where they're out of favor? We have noted that most of the value managers have been out of favor for some time. And when I say sometime, I mean over the last 2 to 3 years, we've seen a pretty big disparity. And actually, not sure if we have, let me look on here before I have you scroll, Andrew, because we may have the slide that shows the difference between, not sure if it's in yours, just the benchmarks. So I'm going back to see if we have, we may not every,
It might.
I'm looking, I'm scrolling really fast. I won't have,
I know.
only,
Let's see if I can.
that's the,
Just, no, I don't think we do.
okay, I'll make sure the next time we put that in, because I do think that it's relevant to look at the difference between value and growth. I mean, in some cases, the spread is anywhere from, could be close to 10%. And that's a huge spread just because, you know, you're operating versus equity, value versus growth. So.
I always like to point out, though, I mean, I know we're still in preliminary stages for into May even, but just sort of on a recovery perspective with values, if you see Causeway's market values at about 32.8 million, right in that, under that market value column. As of the end of May, they've already made up, they're back at 37.3 million. And that's the case with a lot of the managers, that they, instead of, you know, they lost a lot in that first quarter, but they're also gaining back millions at a time. So
Yes.
So this was the worst that had been all year at this point, but need to see it.
Right. Okay.
The other area that was challenged where you're not, so Causeway, which is a non-US manager, as well as your emerging market managers. And so DFA was another one. It's a quantitative strategy. So they really, what that means is that they look at models to identify stocks that they participate in. It's a very large portfolio, you know, thousands of names. And so that portfolio, as you can see, down 8.2% is significant, as well as, you know, for the 1 year down 12%. So these are all the things that are participating in that total negative or down performance that you are seeing. Now you compare that to an Invesco, which has been, this is clearly, you know, again, absolute performance is still down, but they are really a high flyer as it relates to compared to the benchmark. So they're sitting in green. But I would say, you know, DFA and LMCG were definitely hurt during this period. Your global manager, you know, again, behind a bit, that would have been Exponents. Not all of this performance is going to be theirs, because as you remember, they took over that portfolio portfolio from Progress. So with that in mind, you know, they haven't made any changes at this point. They've just been trying to absorb the portfolio. And then fixed income, in particular, Exponents. And so Exponents definitely is showing negatively here, down 14%, which is pretty significant. And so, you know, we've had some calls with them to try to understand what's going on. It doesn't appear to be anything broken, but we are going to be following them. Yet again, this is a manager that, I don't know, a year ago, they were sitting, instead of being in the 99th percentile, they were in the first percentile. So we're seeing a lot of volatility, a lot of whipsawing back and forth. And so, you know, if managers don't have a broken process, I would be hesitant of just terminating them during this extraordinarily volatile time. And so what I'd like to see is give markets a little bit of time to start to rebound. We had an unprecedented situation with COVID. And so it has impacted the markets, and it's impacted the spreads, I should say, on the fixed income arena precipitously. EMD Lazard has done well. And so, I don't focus as much on the good news because that's what we expect. So I think my focus is more on if there's any problems or issues in the portfolio.
You want to talk about any of those guys?
Yeah, GMO, that's short-term negative performance. So, I mean, I think I'm pretty comfortable where we are still with here. What we did do though, as a tactical move last year, or strategic move last year, actually not tactical, was we did bring down that GAA. It had gotten to be much higher, and so we brought those level down. And so the next thing that I would say is we probably will be looking at consolidating the managers, because we have 3, and at 5%, I don't know that that's necessary, and we may have some overlap. And so that's something I would say to come. And then in the the hedge fund arenas, I always anticipate they're going to be a little bit all over the board. Interest is showing well. Grosvenor, which is your main manager at this point, was able to beat the index, which is what we like to see. And then your niche manager at Whitebox was struggling a bit. And so we saw that portfolio performance play out here. So I think that's, unless there are questions, probably want to turn to the private market performance review for these others.
Yeah.
Are there any questions?
If we say we're going to put them on watch, how do we go about that? Or is it just something that how do we go about that?
Just a recommendation. So, I mean, I think given the performance, even if they come out of this, and I shouldn't say even, because that suggests that it's a low probability, but given the performance that we've seen over multiple time periods from DFA and Causeway, I would recommend that those 2 managers be put on watch. And, LMCG, we haven't seen a lot of the performance yet because they are a relatively new manager for us. But I do worry that there might be some cracks in the system there as well. But I would hold off on LMCG, per your policy. I don't think that they've triggered it yet. So if we want to stay in line, and we've been talking a lot most recently about the policy and making sure we're in line with that. I think that DFA and calls should go.
So when you say put it on, when we recommend watch, that means your company pays attention to that company.
I think it means that we're all paying attention. I mean, we're paying attention anyway, but now it's a heightened, kind of sort of, I guess, focus. And, historically, I know you all didn't have managers come in unless they were on watch, but, the one maybe nice thing about using Zoom is that actually it probably would be easy if we would like to have Causeway come and discuss what's going on with them and why. We don't have to worry about anybody flying. They just can click on. So actually, in particular, given that we have new board members, I think it's a great educational component to have some of the managers present. It doesn't need to be long, but, because we've already got into what they're doing, but just essentially really working to understand why and what their outlook is.
Well, I would like that. Those companies that are on watch in a rotating basis or something, to have them come in and present to us.
Yes. I mean, and that's just easy. We just, invite them to the next meeting.
Mm-hmm.
And Andrew, don't we have like a standard that we at least used to have, that if
a company was on watch for X amount of time, then they automatically were invited in?
Yeah, it's in the, they're in the, it's not automatically invited in, but it would be advisable at that point, yes.
Right.
And so it is so many, I can't remember exactly what it is, but so many consecutive quarters.
I think it's 3.
It is, so it's, I mean, so less than a
Right.
year of underperformance. You know, they would be, I think it'd be a good idea. And I don't believe that's happened for a long time with anybody. It
I
may have,
think it's a
but
good idea to do that
I would
on a rotating basis or something.
Well, and I also would say, you know, given in particular with Causeway and DFA to a point as well, all periods are negative and we're in this shock. I think that being a bit closer to the managers during this period of time makes a lot of sense. It's just prudent. And so
Yeah.
even if we weren't quite triggering it, it would be my recommendation. And especially it's just really easy to do, to have, you know, them
Right.
present, you know, what's going on. And quite frankly, maybe by the time our next meeting, because I think we're not meeting till August, right?
Right.
Right.
August
It may be,
20th.
I'm sorry?
August 20th, I think.
Right, August 20th, right. And I know we have other things on the docket, so we can talk about whether or not August is the right time. But it could be that they have already, you know, that performance has been absorbed. But I think just knowing that, you know, making the action or the recommendation that you are going to have them come in bodes well for the trustees and them taking on their fiduciary responsibility.
do you want me to put up the, it's, as I told you, it's summarized for us here.
Okay.
With
Let me see what you
and it's
have.
by category. This should look familiar. It's that, so this is the private equity page, followed by private debt or credit, and then
Yep.
the real estate. Okay.
Yep. And I'm going to pull up mine as well, just in case I have to want to say something else.
Yeah.
I have my notes here.
Oh wait, I have to share it, guys. Sorry.
Yeah.
I thought I did, but I didn't. Hold on. Hold on. Give me a second. I think I have to open it back up. Keep talking. I'll be right here.
Yeah, no, I'm just,
It's going to take me just a minute.
So in our August meeting or our next investment meeting, should we just ask Causeway and, or what is it, RGB to, if they can join us for a minute? Is that what we're going to do?
so there's a question mark there because I think Trustee Darnita had, you know, was thinking about having some education on private equity that was
Right.
scheduled.
Yeah.
And so that's scheduled for 45 minutes
Right.
at your
Okay.
August meeting. And so the question I have, you know, given everything, you know, you all run a fairly tight ship of trying to have a
Right.
2-hour meeting. And so, or under, and so, you know, to have 2 managers come in might be a lot. You may want to move
Right.
that to
We could have
September.
one.
And is that,
Okay.
and the education is doing our investment meeting or doing our regular board meeting?
Investment meeting.
Best.
Okay, okay.
I'm still trying to find it. I am so sorry. Here it
No
is.
worries. I'm going to just talk while you're looking
There
for
it is.
that.
There it is.
Okay.
I started talking and I opened it on mine and forgot to share it. So
Do you have the private, is this the private equity report?
this is from the private equity report. So this is that summary page
Right.
by category. Sorry. So this is the private equity part.
Yeah. Do you want to go to the beginning or do you have a beginning on there?
I do not. This is what I have. Okay. Right
Okay,
now.
that's fine. Hey, that's fine. We're gonna go with it.
Okay.
So, you know, just to give you background or remind you, we have, and we're gonna have some education around this. So this is gonna be, you know, pretty good to kind of be over this now. But you have 3 areas in the private markets that you are invested in right now. It's private debt, which is, you know, the debt of companies. Private equity, which is the equity of companies like ownership, but again, reminding you that these are not traded publicly. So these are privately owned. And then you have private real estate. So those are the 3 private markets that you have in your portfolio. And presently, when we look at the performance, so while we provide performance in the larger book, And however, the most appropriate way to look at private markets is their internal rate of return. And they're going to define that for you, but your internal rate of return lets you know how good the portfolio has done. And so just for high level, to give you perspective, your private debt portfolio, you presently have about $32 million committed, of which 26 million has been contributed. And as a reminder, this is a drawdown structure. So unlike when you have a equity manager and you just put all your money in at one time, this is drawn down over time. So as they find opportunities, they will call. They call it a call. So they call Andrew and say, we found opportunities, please send us $1 million to invest in it. Even if you have committed to them 5 million, you may still be holding on to that 4 until those opportunities come to play. And so with that in mind, just to give you some perspective, your quarter was at 1.28%. Now, I want to also give you perspective that you see there's a December 31st time price on here, timestamp. That's because private markets are reported on a lag because they have to be audited. So when we say quarter, we're really talking about pre-pandemic. However, your private markets portfolios have been doing what you want them to be doing. So your private debt portfolio has generated 9.3% return to the fund since inception. Your private equity portfolio has generated 10.43% return since inception. So those are strong numbers. And your real estate portfolio has returned, and it's a little bit newer, your private real estate, and they had a very good year last year. And so they've returned 26.98% return. So they just.
Kristen, I think it's a good time to point out, because I don't think we've had a chance to talk, but that Elm Tree Net Lease Fund, they sold. And so they are, we did well with them. And it was a very short time horizon.
Exactly.
And so we were if you'll look that the cumulative distributions came back at 8.4 million, and we actually only paid in 5.5 over that life. So, and they sold and made a ton of money for us.
Right, which is why we have that what I'm going to call outside or anomaly return of 20%, 26% for 1 year. While that's outstanding, and I'm glad that we were able to garner it, we expect somewhere around 8-9% from real estate. So this was just one of those opportunities that that you all benefited. So I wanted to just give that high level to you as it relates to the private markets and explain to you what that performance is. You have multiple strategies. I mean, right here, you see the Q4 performance. You have Big Real Estate and Elm Tree. So both of those have done well. Big is like a private real estate debt fund. And then, of course, Elm Tree is a net lease. So again, strong performance in both cases. Real estate debt is up 9.41 is their internal rate of return. So again, that's positive. And just as Andrew was kind of mentioning, the way you look at it, you see your investment name, you see your vintage year. Your vintage year is the year that you actually invested. And so that when I say that this is a great vintage year right now to invest, that's what I mean, because we're coming out of a recession. You have your commitment, your total commitment. So that would have been, I think that's $8 million for Big. I'll just stay with the top line. And then unfunded commitment means that you haven't put it all in. So you still have another 4.4 million that could be called. So you scroll over, you see paid in capital. That's 3.5 million. So that's the delta. So 4.4 and 3.5 equals that 8 million. So you already paid in 3.5. You still have 4.4 to pay in when they call it. And they have fees, of course, and then they've already started to make distributions. So it's early in this fund because it's only a 2018. We're very, I guess in the middle of 2020. Remember that these investments are over anywhere from 8 to 12 years. So we're early. We're in the investment stage. But it's nice to know that they've already given you some of your money back. And then when we look at the valuation, you see you have a valuation of 3.5. So you paid in 3.5, you got back 737,000. So your valuation at 3.5 plus that distribution gets you up to that 4.2 million. So you've already had a net positive benefit in 2 years of almost $500,000. So that's just how you have to think about it when you're reading these. And then that IR, so I won't worry about those two DPI and PP, but I think the bigger number you want to know, because I've just gone over a lot here, is that IRR at the end. So you see 9.41% and you see, 39.23%. So that would have been the quarter, which of course is when they sold. That's why it's so high. So I hope that was helpful to you.
Hey, Kristen, sorry.
Yeah. No worries.
My alarm didn't go off when I was doing something else. So go back to the previous slide with Elm Tree.
Sure.
They pretty much have paid up quite a bit for us.
Yeah, they were sold.
They're sold.
So they sold, and they have another fund that is currently going on.
Mm-hmm.
What do we think about getting back into that asset class, one of their newest? Because just because it's sold, we still want to have, you know what I mean? Some type, obviously that's in liquidation because that's only 133,000.
Mm-hmm.
I haven't seen any of their new paperwork. He's been bugging me. But that was a pretty profitable investment for us in a very short period. To me, what I'm looking at with Elm Tree is they get in. The last two funds they have sold as well, but the returns have been pretty good for us.
I mean, they did a great job. I would not be opposed. I'm not sure if you were on, but we were talking about how this is a great vintage year to actually invest this year. So that's something that we can, move forward. I'll look to see if we've actually underwritten it or not. I don't know, but to your point, it is a firm that you have already invested in. And so it should not be an issue to, evaluate it and make a recommendation. You are not at
I'd
your
like
target.
to look at that and put it on the radar for, I don't know when their total closing is. I know they have a second quarter, but I just haven't been paying attention. I don't know what their goals are. I have not seen anything on their new fund, but they are in the midst of closing on various stages on that fund. And given their track record, they raise this money, invest it, and then within a couple of years, they sell their fund to an investor. And those returns have been pretty good for us, for them. This has been good. So can we look at that?
Absolutely.
Thank you.
You're welcome. So I think that, I don't know if there were any other questions. Andrew, maybe turn to the next page.
There is not a next page. I only have put the three together.
Oh, right. Okay, so just if you just sit here for a second, I just want to go through this page and then the next one being private equity or private debt, and then I will be actually done with my formal comments. But I just wanted again to remind you, this is the same format that you're looking at with the investment, the commitments, contributions, valuations, and then performance. And so if you scroll on that last line, that IRR, you can kind of see as you scroll down the managers that have done really well for you. And so most of them have done well. There are some, what I'm going to call very early vintage year in the early 90s that did not do really well. That's a little before my time, but those were investments that were made. But you can see subsequent to that, you have a lot of strong returns. And so not sure, what was going on there, but what I will say is that the selection has been really positive since then. And if you look at your total IRR, despite having those negative funds in there, you're at a 10.43, which is, is value add to your portfolio. It is, and it shows sort of that illiquidity premium that you get. It also allows for what I'm going to call a smoother ride. So with the public markets, they're daily being marked to market. So you know exactly what their value is on an everyday basis. for private equity or private markets in general, you don't, which means you, hopefully it'll be positive, but you'll get that positive over time. And so it's a smoother ride. So it just doesn't create the same noise in your portfolio. That's another benefit. And if you could turn to the private debt, Andrew. So we have a fewer managers here, but I think that this is another area that in particular, I would like us to spend a bit more time evaluating what opportunities. The 3 funds that you have, Brightwood and the 2 Monroe funds, are really, those are really private lending, private debt. You actually have a 4th fund, as I was speaking, MC Credit, which is going to be able to take advantage of the distressed market. It's not in here yet because you have to have a certain period before it rolls onto the portfolio. And I think we invested towards the latter half of last year. And remember, this is a December 31st report.
I'd have to look. I don't think that that anything was called until the beginning of this year. I know they've called down a little bit, but.
So with that in mind, there are other opportunities out there that focus on distressed and what I'm going to call niche lending. And given the markets that we've had, the volatility, COVID, and the like, those are where, you remember I talked about opportunities. And so I want to make sure that we are able to take advantage of opportunities. And you do have space. You're not at your target yet. Moving into private debt, we knew was a multi-year process. So I think that was all I wanted to share with you on this report. I don't know if there are any other questions. And we spent a little more time going through it, but okay. If not, then that actually concludes my formal remarks. And as mentioned, we are working through having education in August, and we can talk about, I'm going to look at the calendar, look at the pipeline, and see whether, as you mentioned, we bring in either DFA or Causeway to talk about their performance at that meeting. The only other, I guess, item that I want to make sure that we addressed is if Elm Tree possibly, or any of these private debt funds are closing, we may want to push off a manager meeting to address potential investment if the pipeline is going to be closing. We don't want to miss an opportunity. So that's why I'm being a little, I'm hedging a little bit there, because I do want to look and see, and I will communicate with the chairs, Christina and Albert. I'm sorry?
Christine.
Right.
Yeah, I said Christina.
And the reason
Right.
too is because usually these private debt or private market transactions always have a quarter end close. So we don't want to get caught trying to do something in the fall and then miss a December close, or get the ball rolling. And then if we commit, then they will probably let us do I don't know if we can do a September given legal docs and everything, but try to get, if they do have anything in December, try to get a December close so that we have a vintage year for this year, which that seems like a long way away, but it really isn't, given all this, the meetings, the approvals, and then the documentation.
So it sounds like we're on the same page. So, and I will be corresponding, with the investment co-chair, Christina, Albert, Andrew, Darnita, to try to calculate or incorporate the education component in. So we'll know well in advance, but I think this is a good trajectory that we're on.
Andrew, you have any other comments?
I do not. No, I think that, given what we went through by the end of the quarter, and then what's happened since, which is a slight recovery, the value did pop back up a bit through the end of May. So we'll see what this quarter actually does in just less than 12 more days.
Mm-hmm.
Hopefully it'll be, anything positive is a good news.
That's right. Absolutely.
Well, good. Well,
all right, so
thank you.
Do we have anything else?
No, we went through, we spent a good amount of time doing a bit of more education during this meeting. So
Good. Andrew, if there's no other business, then I like to see if we can get a motion to adjourn.
So moved.
Second,
Second.
Sheila second.
Sheila second. Okay.
Yep, all those in favor?
Aye.
Aye.
Bye.
Have a great weekend. Happy Father's Day to everyone. And we'll see you guys Monday.
Yep.
Yes.
ma'am. Thank you.
All right.
4:30.
Not you.
Monday is 4:30, right?
30.
4:30.
Okay.
maybe that's where I said the 4:30.
Right.
But I'm not joining on Monday, right?
You were not.
Okay.
Ground.
I will. So you know what? Everybody have a wonderful summer because Darnie told me we're not meeting till August. So I'll
Yeah.
see you guys in August.
So Kristen,
Okay.
I
Okay.
apologize. Did you give an update on progress assets?